The standard American financial pitch is straightforward and rarely questioned. You are told to save pre-tax money in a corporate 401k, lower your current tax bill, and follow a predictable path to a comfortable retirement. This strategy relies on a powerful psychological incentive. Lowering your taxable income today feels like an immediate win. It creates a sense of financial virtue to see that current tax liability drop. However, a traditional 401k doesn't actually eliminate your tax burden. It merely procrastinates it. By following this default path, many workers are unknowingly building a tax time bomb. They are accumulating wealth in a structure that legally surrenders a massive portion of their final balance back to the government at the exact moment they stop working. To understand the true cost of this arrangement, we have to look at the mathematical impact of taxing a harvest instead of a seed, the persistent drain of institutional fees, and the specific rules that restrict access to your own capital. This multi-trillion-dollar landscape is built on a structure where institutional fees and future tax claims are positioned to absorb a significant portion of your total savings, regardless of how well the market performs. Conventional financial advice focuses almost exclusively on the short term, contributing pre-tax dollars now specifically to move into a lower current income tax bracket. This graphic illustrates the concept of taxing the seed. By paying taxes on your original contribution today, you are giving up a small, proportionate slice of a small pile of cash, while the tax rate is a known quantity. Contrast that with taxing the harvest. By deferring your taxes, you give the government the right to tax your original contributions plus 30 years of compounded growth. You are essentially inviting a partner to take a percentage of your final result rather than your initial investment. This means you are committing to a future tax bill without knowing what the tax brackets will actually be when you reach 65. This chart shows the correlation between national debt and tax liability. With government spending and debt at record levels, there is a strong probability that future ordinary income tax rates will be higher than they are today. In the tax-deferred model, you take 100% of the market risk for decades, while the government remains a silent partner entitled to an unpredictable cut of the back end. While you wait for that future tax bill, the account is subject to fee leakage. Wall Street firms extract administrative and management fees every year, regardless of whether your portfolio is up or down. As this compounding growth curve shows, a seemingly small 1% expense ratio is incredibly destructive. Over 30 years, that tiny fee can erase over $100,000 from your final nest egg. Beyond the fees, there is the issue of liquidity. These accounts act as golden handcuffs, severely limiting your ability to use your own capital before retirement. If you need to access these funds before age 59.5 for an emergency or a high-yield investment, the system triggers a strict 10% federal penalty, in addition to immediate income taxes. The traditional 401k creates a scenario where your wealth is drained by fees, and your access is restricted by penalties, all while you move towards an unknown future tax liability. Maintaining your standard of living in retirement requires moving beyond these corporate defaults toward a strategy for capital control, a framework we call the Sovereign Retirement Blueprint. The first step is to contribute only enough to the traditional 401k to capture the full employer match. An instant 100% return is the only reason to accept the account's structural flaws, but the funding should stop exactly at that match limit. Next, redirect the remaining flow into Roth accounts. This allows you to pay the tax today at a known rate. By taxing the seed now, you ensure that decades of compound growth can be withdrawn completely tax-free later. You should also maintain a taxable brokerage account. This provides the liquidity you need to deploy capital at any time, without facing government penalties. Finally, look toward building independent cash-flowing assets that you control directly, moving your future away from institutional fee structures. By paying the tax today and diversifying how you store your wealth, you remove the government from your future gains and take back total control of your financial life.